Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. And today we're going to talk about, is it too late to invest overseas? Paul, I guess the most important question is, why would you want to invest overseas?
Look, three really strong reasons. First of all, the Australian market is very small, Peter. About 2% of the world market. So that means that 98% of opportunities are outside Australia. So that's a pretty powerful reason. Secondly, the composition of our market, the Australian market, is very different to what it is overseas. And this is perhaps best illustrated by looking at the difference in the sector composition of the Australian market versus the United States market. And this is some data from S&P and compares the different industry sectors of the Australian market versus the US. So the Australian market, very heavily overweighted with financial stocks and material stocks, the companies like the BHP and Rio. So financials, for example, around 32% in Australia versus only 14.2% in the United States. Look at materials, 18.8% for the Australia versus 2.8% overseas. So we've got big biases there. Conversely, look at information technology, just over 2% in Australia, but something like 26% in the United States. So we just don't have...
Quarter of the market. It's extraordinary.
We just don't have the Microsofts, the Apples, the Netflixes, the Amazons. You cannot buy those companies in Australia. Even companies like sectors like consumer discretion, we don't have those big names, and even healthcare, we don't have the big drug companies. So there are lots of opportunities outside. The third reason, Peter, is simply about performance. This is some data from the Reserve Bank that looks at the performance of the Australian market versus the United States market and versus the world. The world in blue, the Australian market in black, and the S&P 500, the US market in red, going back to 1994. So since 26 years or 24 years versus data, and you can see the Australian market has underperformed. So, arguments about performance, arguments about sector composition, companies availability, and thirdly, just our market.
And it has been the era of high-tech companies. It started in the dot-com bust and then rocketed on through until today. So that's why we've struggled. Now, Paul, I guess the important question is, you made the argument pretty effectively, how to invest overseas.
Well, it's actually really easy on the ASX to invest offshore. And there are four different types of products. Let's look at the managed products first. So probably the easiest is just simply exchange traded or funds, usually which generally just track one of the indices. So it's a company like IVV from iShares, which tracks the US S&P 500 in a simple basis. We have a newer form of active product, which is so-called these quoted managed funds, Peter, that where you've got a manager actively picking the shares and using a strategy. Things like MGE, that's the stock code for Magellan. There's quite a few products from Platinum on the market. Traditionally listed investment companies, lots of specialists there. Companies like EII from Elliston, which looks at Asian investments. You've got Contango Global Growth that follows a particular strategy. And finally, just buying the actual shares. It's actually, through NAB Trade, pretty easy these days. So
it used to be hard.
It used to be hard, but NAB Trade's made it easy. So if you want to go invest in Facebook, stock code FB, that's easy to do. But it's not just the US market. You can invest in Asia or Hong Kong or European markets. So actually investing offshore today is pretty straightforward.
Okay, the case is made, but there are other considerations people have to be aware of. So let's go through. Of course, the first one is yield, isn't it?
Yeah, typically you won't get the same sort of yield by investing offshore as you will locally. So we have a very strong bias in the Australian market for yield, and also that's enhanced by franking credits. But yields offshore in most overseas markets are a lot lower. This is some data from the Reserve Bank that shows the average yield of the Australian share market versus the average yield offshore, about 4% in Australia, about 2% offshore. So you won't get a high yield if you invest offshore. So that's just the first thing to be a consideration. And secondly, of course, is about the currency. Now, if you invest offshore, you take risk in terms of how the Australian dollar is going to perform. Generally, if the Australian dollar weakens, you're going to do better. If the Australian dollar appreciates against the overseas currencies, you're going to be worse off. So you've got to question whether you want to be hedged or unhedged. Sometimes the manager will do that for you. They'll worry about the currency risk. In many cases, the manager won't. So that's just something to look at. Here's some data from the Reserve Bank that looks at the value of the Australian dollar over a very long period, since 1988. You can see that, for example, against the US dollar, we've been as high as about $1.10. So for one Australian dollar, you got $1.10 American, and as low as about 48 cents. So for each Australian dollar, you only got 48 US cents. At about sort of 76 cents, we're sort of about mid-range.
Yeah.
I personally don't really see the advantages of hedging, but of course you would hedge if you expect the Australian dollar or you're really worried about the Australian dollar appreciating. I think that perhaps a bit of portfolio diversification, there's an argument to invest on an unhedged basis.
And of course, we haven't talked about franking credits. That can be another reason why some people don't invest overseas.
Yeah, so if your basic motivation is income, then maybe investing offshore is not as attractive. But again, sometimes you can get caught in so-called yield traps, and we've seen that, as I said, the performance graph showed you that there is a very strong reason to invest offshore.
Okay, Paul. So if someone isn't invested now, is it too late to invest now overseas?
Look, I don't think it is too late. I mean, there's, first of all, is the old adage, Peter, it's about time in the market rather than timing. I found that adage makes a lot of sense. Yeah. I'm not very good at picking times always. No. Secondly, here's some data from the Reserve Bank that looks at the so-called forward PE ratios over the long term. So PE, of course, the price earnings ratio, often the benchmark about trying to judge whether markets are cheap or expensive. This is looking at what analysts expect the PE ratio to the price earnings to be. You can see where we are at the moment. It's a little elevated, but we're not way out of order, and so I think there's an argument that perhaps there are still some opportunities offshore. Certainly the US markets are high, but of course what's happened in the US and why the market is high is earnings have increased.
And the economy is good.
And the economy is good, and that's why the PE ratio, if anything, has not risen so much. So I still think there's some value. What's your call?
Yeah, I tend to worry when a PE gets around 20. And that was based on the idea that interest rates when a PE is 20 is usually around 5%, and 5% and PE 20 match up pretty closely. Interest rates are so low, Paul, I'm not worried about PEs and I'm not worried about stocks going forward. So if you're not invested overseas, it's not a bad time. I also think the dollar will fall over the next year or two, and that's going to be good for people investing overseas. The best time to buy overseas was when the Aussie dollar was $1.10.
That was the best time.
The best time.
We missed that, but a lot of us missed that.
So people should edge their way in, I think, if they haven't got exposure to overseas markets. So that's Switzer Investing Insights, brought to you by NAB Trade. Thanks for joining us.